and expenses rise here. And there's a lot to break down within CarMax's results. You're seeing shares down here early in trade by about 16%. And particularly, they talked about some of the...
CarMax delivers some fantastic numbers. A 10-cent earnings beat off a $1.49 basis with higher than expected revenues and same-store sales rising 9.5% year over year.
The used car king just blinked. CarMax suspended their long-term growth targets and shares fell 16% after earnings. Not because of one bad quarter, but because they can't predict what's coming next. When the industry leader with 250 stores and 789,000 annual sales admits they're flying blind, that's not a company problem. That's an industry apocalypse. They said the used car market was stabilizing, that inventory was normalizing, and reasonable prices were returning to American driveways. They were setting you up for the biggest automotive collapse in modern history. The real villains aren't CarMax executives, they're just the messengers. Their broken affordability math that prices working families out of transportation, misaligned inventory strategies that stock 30,000 plus cars while customers need 15,000 reliable vehicles, and tighter underwriting standards that choke off financing for middle-class buyers. While you're struggling with car payments that feel like rent, they're manufacturing scarcity through floor plan financing that bleeds dealers dry. CarMax's guidance freeze reveals what smaller dealers already know. The math doesn't work anymore when average used car prices hit $25,373 and financing rates exceed 11%. They keep prices artificially high while credit tightens like a financial noose around working families. CarMax processes over 1 million transactions annually across 41 states, making them the Walmart of used cars. When they admit they can't read the market, every dealer in America should be terrified. Why does CarMax's panic matter more than your local dealer's struggles? Because their scale gives them real-time visibility into every credit tier, income level, and regional market that smaller operations can't match. CarMax isn't just another used car dealer. They're the industry's early warning system. With 250 locations processing 789,000 retail sales and 540,000 wholesale transactions annually, they see market changes before they hit headlines. Their national footprint detects consumer stress in Texas, subprime collapse in Florida, and affordability crises in Arizona months before official data confirms the trends. When CarMax suspends forward guidance, they're not being cautious, they're sounding the alarm. Their data scientists track payment-to-income ratios, credit score distributions, and regional demand patterns that reveal economic stress before it shows up in unemployment statistics. They have access to real-time consumer behavior data that government agencies won't publish for months. CarMax sees families trading down from SUVs to sedans, prime customers choosing cheaper vehicles, and subprime buyers disappearing entirely from the market. If CarMax can't predict the next 12 to 18 months with their data advantage, what chance do independent dealers have with limited visibility and local market knowledge? Let's decode the earnings call that sent shockwaves through every dealership in America and revealed the truth they've been hiding. CarMax reported comparable store sales up slightly, but CEO Bill Nash delivered the bombshell that froze the entire industry. We are suspending all long-term growth targets. We simply cannot predict with any confidence what the next 12 to 18 months will bring. When the most data-driven used car retailer in America throws up their hands, that's not conservative planning, that's panic disguised as prudence. Investors understood immediately, sending shares down 16% in after-hours trading as $3.2 billion in market value evaporated. The earnings revealed inventory chaos that contradicts their organized reputation. Nash admitted vehicles were being parked in overflow lots, employee parking areas, and even driveways because traditional lot space couldn't handle the volume of cars they can't sell. They also boosted loan loss reserves to $11.7 million, a 25% year-over-year increase that assumes no economic deterioration. If unemployment spikes or interest rates climb further, those losses could spiral into territory that threatens their entire business model. The message was clear. Even CarMax doesn't know what's coming, and that should terrify everyone. They chased high-margin vehicles during the boom years, and now they're stuck with inventory that working families can't afford. CarMax's lots are flooded with $25,000 to $35,000 SUVs and trucks that generate healthy profits when customers can qualify for financing. The problem? Shoppers desperately need $15,000 to $20,000 reliable transportation, and those vehicles either don't exist or get snatched up instantly at wholesale auctions. While they're sitting on expensive inventory that bleeds floor plan interest, customers are walking away because the math doesn't work. A $28,000 used SUV with 7.5% financing creates a $450 plus monthly payment that exceeds many families' grocery budgets. Appraiser Mike Rodriguez, scanning auction lanes, every decent $17,000 car gets outbid in seconds by dealers desperate for affordable inventory. We're all chasing the same shrinking pool of vehicles that customers can actually afford. The margin chase that worked during easy credit years now backfires spectacularly. CarMax optimized for profit per unit instead of volume, betting that customers would always find financing for premium-priced vehicles. That bet is failing as credit tightens and disposable income shrinks under inflation pressure. They built a business model around selling expensive cars to people who now need cheap ones. They assumed financing would always be available for qualified buyers, but lenders raised the bar so high that even prime customers are getting rejected. Lenders have quietly raised credit score minimums from 620 to 680 plus, while lowering debt-to-income caps from 50% to 40%. Even customers with good credit are discovering that their $95,000 household income no longer qualifies them for the $35,000 SUV they could have financed last year. The credit shrink creates a vicious cycle that destroys sales velocity. Fewer approvals mean longer days to sell, which increases carrying costs and forces higher prices to maintain margins. Higher prices reduce the pool of qualified buyers even further. Sarah Chen, nurse with 710 credit score. I got pre-approved for $25,000, but the payment on anything decent was over $400. I ended up buying a 2018 Camry instead of the SUV I wanted because that's all I could afford. CarMax Auto Finance, their captive lending arm, is tightening standards alongside external lenders. When your own financing company won't approve deals, you know the credit environment has fundamentally shifted. The approval rates that drove their growth model are evaporating, leaving them with inventory they can't finance and customers they can't serve. They built their model around middle market demand that's disappearing faster than their ability to adapt inventory strategies. The market has gone barbell. Customers want either sub-$20,000 transportation or true luxury vehicles, with the middle segment collapsing. CarMax's sweet spot of 25,000 to 35,000 vehicles sits in the dead zone where demand has evaporated. Days to sell metrics reveal the brutal reality. Vehicles under $20,000 move in 30 to 45 days, while anything over $30,000 sits for 90-plus days bleeding carrying costs. The middle market that built CarMax's reputation is vanishing as customers either trade down for affordability or trade up for genuine luxury. Online shopper filtering search results. I set my budget at $15,000 to $20,000 and got no vehicles match your criteria on 3 different dealer websites. Everything decent starts at $25,000, which I simply can't afford. The demand shift forces impossible choices: stock affordable vehicles with razor-thin margins or maintain profitable inventory that doesn't sell. CarMax chose profitability over velocity, and now they're paying the price through extended carrying costs and reduced turnover. They're selling to a market that no longer exists while ignoring the market that desperately needs their service. We don't wait for them to fix the market. We take control by sharing information that levels the playing field. If you want the truth about what's really happening in used car lots across America, hit subscribe right now. We're building a community of informed buyers who refuse to get steamrolled by an industry in panic mode. Share this video with anyone you know who's car shopping. Don't let them walk onto a lot blind to the desperation that's driving dealer behavior. Knowledge is power, and power shifts negotiations in your favor. Download the free guide, 17 Cars to Avoid in 2025, in the description. This isn't just a list, it's your armor against dealers who are getting increasingly desperate to move inventory at any cost. Let's decode the wholesale auction data that reveals why CarMax's forecasting models are failing spectacularly. Manheim Used Vehicle Value Index shows month-to-month cooling, but year-over-year prices still elevated, creating forecasting chaos as wholesale and retail markets move at different speeds. The lag between wholesale price drops and retail price adjustments creates margin compression that's killing profitability. Wholesale values decline 0.5% monthly, while retail list prices remain sticky, is squeezing dealers between falling acquisition costs and stubborn selling prices. Wholesale down 0.5% monthly times 12 months equals 6% annual decline, but retail prices down only 2% annually equals 4% margin compression that destroys unit profitability. CarMax's data scientists can track these trends in real time, but they can't predict when the retail market will catch up to wholesale reality. The timing uncertainty makes inventory planning impossible when you're buying vehicles today to sell 60 to 90 days later. The retention and conversion metrics that drive their business model are breaking down as customers delay purchases, shop longer, and ultimately walk away without buying. When your most sophisticated data analysis can't predict customer behavior, you suspend guidance and hope for the best. They push monthly payments while we protect total cost of ownership, and the difference is bankrupting families who don't understand the game. They want you focused on whether you can afford $450 per month. We ask whether you can afford to lose $8,000 to depreciation while still owing $12,000 more than the vehicle is worth. The payment trap keeps you perpetually underwater, always needing their financing for your next purchase. Small changes in APR and debt-to-income ratios kill deals that would have sailed through last year. A customer who qualified for 6.5% financing in 2023 now faces 9.5% rates, adding $75 plus to monthly payments on the same vehicle. F&I office scene. We can get you approved, but you'll need the extended warranty and gap insurance to qualify for the rate. The customer sees the trap, mandatory add-ons that turn a $350 payment into $425. They socialize the risks while privatizing the profits. When loans go bad, taxpayers backstop the losses through government-sponsored enterprises. When deals work, shareholders collect the gains. We focus on out-the-door pricing, total interest paid, and realistic resale values that reveal the true cost of their financing games. The affordability crisis isn't hitting equally. Certain regions are experiencing financial collapse that's spreading like wildfire through dealer networks. Texas, Florida, and California lead the affordability pinch as housing costs, insurance premiums, and basic living expenses consume larger portions of household budgets. What's left for transportation shrinks monthly, forcing families to delay purchases or accept longer commutes with unreliable vehicles. Default rates are creeping from subprime into middle credit tiers as inflation erodes purchasing power faster than wages increase. Customers who looked stable at purchase are falling behind when everything else gets more expensive simultaneously. Teacher couple in Austin. We came looking for a $23,000 SUV with our 720 credit scores. The bank said our maximum approval was $17,000 because our housing costs increased 40% when our lease renewed. Regional stress patterns reveal where the crisis hits first. Energy-dependent economies facing job uncertainty, tourism markets with seasonal income volatility, and high-cost coastal areas where housing inflation destroys transportation budgets. CarMax's regional data shows these stress patterns months before they appear in official statistics, giving them early warning of markets to avoid and inventory to redirect. Everyday vehicles sit unsold. Dealers pay floor plan interest that turns profitable inventory into financial quicksand. $30,000 vehicle times 8% floor plan rate divided by 365 days equals $6.58 daily carrying cost. At 120 days average, that's $790 in interest before the first customer test drives it. Time becomes your negotiating weapon when you understand their desperation. That truck sitting for 150 days has cost the dealer $987 in floor plan interest. Money they'll never recover regardless of final selling price. GSM checking floor plan statement. Each week we don't move these SUVs costs another $46 in interest. I'm authorized to discount $2,000 just to stop the bleeding on anything over 90 days. The carrying cost math explains why dealers become increasingly flexible on aged inventory. What starts as firm pricing becomes negotiable desperation as calendar days accumulate into real financial losses. CarMax's advantage is their balance sheet can absorb carrying costs longer than independent dealers, but even they have limits when inventory turns slow and interest rates stay elevated. Their guidance suspension reflects the reality that carrying costs are destroying profitability across the entire industry. The used car crisis is destroying new car dealers who depend on trade-ins to stock their pre-owned lots and maintain profit margins. Trade-ins are vanishing because customers are underwater on current loans and can't afford to roll negative equity into new purchases. Without those trades, franchise dealers lose their primary source of used inventory and the profit margins that keep their operations viable. Toyota Service Manager: we used to get 15 to 20 trades per week that went straight to our used lot. Now we're lucky to see 5, and half of those have negative equity we can't absorb. The trade-in drought forces franchise dealers to compete at wholesale auctions for the same limited inventory that CarMax needs. Bidding wars drive acquisition costs higher while retail demand weakens, creating margin compression that threatens dealership profitability. New car incentives are returning as manufacturers try to stimulate trade activity, but even aggressive rebates can't overcome negative equity positions that trap customers in vehicles they can't afford to replace. The ripple effect means fewer used cars available, higher prices for remaining inventory, and reduced selection for customers who desperately need affordable transportation. When franchise dealers can't stock used lots, the entire automotive ecosystem starts breaking down. The companies that finance automotive dreams are waking up to a nightmare of rising defaults and charge-offs that threaten their entire business model. GM Financial, Ford Credit, and Toyota Financial are reporting delinquency rates climbing faster than their risk models predicted. Customers who looked stable at origination are falling behind as inflation destroys their disposable income and forces impossible choices between car payments and groceries. Credit underwriter reviewing applications: I'm rejecting deals that would have been automatic approvals last year. The same customer profile that got 4.9% financing now gets declined or offered 12% rates that kill the deal. Rising charge-offs force tighter underwriting standards that reduce approval rates and eliminate marginal customers from the market entirely. The credit box shrinks monthly as lenders protect themselves from losses that could threaten their capital ratios. GM Financial reported charge-off rates increasing 0.8% year over year in Q2 2025, with delinquency trends accelerating in energy-dependent and high-cost regions. The captive lender pullback creates a vicious cycle. Fewer approvals reduce dealer sales volume, which increases per-unit costs and forces higher prices that further reduce the pool of qualified buyers. Small dealers without CarMax's data advantage or financial resources are failing first as the market collapse accelerates. Independent lots lack the floor plan credit lines to carry expensive inventory for extended periods. While CarMax can absorb 120-plus day carrying costs, small dealers start bleeding cash after 60 days and face bankruptcy after 90 days of slow turnover. Independent dealer in Ohio: we can't carry $30,000 SUVs for 4 months like the big guys. Our floor plan credit line maxes out at $500,000, and we're already at 80% utilization with vehicles that won't move. The data disadvantage kills independent dealers who rely on gut instinct instead of sophisticated analytics. They buy vehicles based on local market knowledge, while CarMax uses national demand patterns and predictive algorithms to optimize inventory mix. Financing relationships that sustained independent dealers for decades are evaporating as lenders consolidate their dealer networks and focus on high-volume partners. Small dealers lose access to competitive rates, forcing them to use subprime lenders that reduce their customer base. The independent dealer extinction accelerates market consolidation that reduces competition and eliminates the local relationships that once provided personalized service and flexible terms. In this chaos, certain vehicles still sell quickly, and understanding the pattern gives you massive negotiating leverage. Under $20,000 vehicles with clean Carfax reports and mainstream appeal disappear within 30 days. Sedans like Camry and Accord, compact SUVs like RAV4 and CR-V, and reliable trucks like Tacoma move fast when priced fairly. Auction lane bidding war. 5 dealers jumped on a clean 2019 Civic with 45,000 miles at $17,500. It sold for $19,200 because everyone knows these cars move immediately. The fast-moving inventory reveals what customers actually want versus what dealers think they should want. Practical transportation with proven reliability trumps luxury features and premium brands when budgets are tight. Price bands matter more than brand prestige. $15,000 to $20,000 vehicles sell in weeks. $20,000 to $25,000 inventory moves in 60 days, anything over $30,000 sits for months bleeding carrying costs. Smart dealers are pivoting their inventory mix toward affordable, reliable transportation while dumping luxury vehicles at wholesale losses. The market is telling them exactly what sells, but many are too proud or financially trapped to listen. CarMax's internal planning documents reveal 3 potential futures, and none of them look good for the automotive industry. Soft landing scenario. 18 to 24-month correction with gradual price normalization, selective dealer failures, and credit standards that slowly relax as economic conditions stabilize. This is their best-case outcome that still involves significant pain. Hard landing scenario. Credit markets freeze, used car prices crash 25 to 30%, and half the dealer network fails within 12 months. CarMax survives through superior balance sheet strength while competitors disappear. Full collapse scenario. 2008-style lending meltdown where automotive financing disappears entirely, forcing cash-only transactions that eliminate 80% of potential buyers. Even CarMax faces existential threats in this environment. Strategic planning meeting. We're stress testing our balance sheet for scenarios where sales volume drops 60% and carrying costs triple. The models show we can survive 18 months of severe contraction, but smaller dealers won't last 6 months. The scenario planning explains their guidance suspension, when your best-case outcome involves industry-wide pain and your worst-case threatens survival. You stop making predictions and start preparing for disaster. If you must buy in this environment, here's how to exploit dealer desperation while protecting yourself from financial disaster. Target aged inventory over 90 days with specific VIN research. Vehicles sitting that long represent dealer desperation and maximum negotiating leverage. Ask directly, how long has this been on your lot? Their answer determines your opening offer. Combine rate buydowns with discount negotiations. Dealers may accept lower profits to move aged inventory, especially if you can secure outside financing that eliminates their F&I profit expectations. Successful negotiation. I found a 120-day-old SUV. Got pre-approved at my credit union for 6.5% and offered $3,000 under asking price. They countered at $1,500 under, and I walked with a fair deal on a vehicle they desperately needed to move. Pre-arrange financing through credit unions or banks before shopping. Dealer financing becomes a backup option rather than your only choice, eliminating their leverage over your approval odds. Trade separately if you're underwater. Sell your current vehicle privately to maximize value instead of rolling negative equity into new loans that compound your financial problems. If you own a vehicle in this market, timing your sale correctly could save you thousands before the repo wave floods the market with distressed inventory. List before the repo surge hits in Q4 2025. Repossessed vehicles will flood auction lanes and depress private party values across all segments. Sell now while demand still exists for clean, well-maintained vehicles. Price to move rather than chasing maximum value. A quick sale at fair market price beats holding out for top dollar while values decline monthly. The market is moving against sellers and time works against your equity position. Smart seller strategy. I listed my 2020 F-150 for $2,000 under KBB value and sold it in 5 days. My neighbor held out for full asking price and is still trying to sell 3 months later while values dropped another $1,500. Avoid negative equity rollovers that trap you in perpetual debt cycles. If you owe more than the vehicle is worth, consider keeping it longer rather than financing the difference into a new purchase. Mind your payoff timing. Loan balances and market values are moving in opposite directions as depreciation accelerates and financing costs increase. Wall Street is about to learn which automotive companies built sustainable business models versus those riding unsustainable credit bubbles. Survivors will have strong balance sheets, affordable inventory mix, and conservative lending practices. Companies like CarMax with deep capital reserves can weather extended downturns, while competitors with high leverage ratios face bankruptcy when sales volumes collapse. Investment screener analysis. I'm filtering for automotive retailers with debt-to-equity ratios under 0.5 and days-to-turn inventory under 60. Only 3 companies pass both tests, and CarMax barely makes the cut. The casualties will be subprime-dependent lenders, luxury-heavy dealers, and companies with extended days-to-sell metrics. When credit tightens and demand shifts toward affordable transportation, business models built on high-margin, low-volume sales collapse first. Short-term pain creates long-term opportunity for companies that survive the consolidation. Market share gains from failed competitors could drive future profitability, but only for businesses with sufficient capital to endure 12 to 18 months of industry contraction. The automotive reset will separate companies with genuine competitive advantages from those that benefited from easy credit and artificial demand. CarMax's guidance suspension suggests even the strongest players are uncertain about their survival odds. CarMax executives blame tariffs for their guidance suspension, but the math doesn't support their excuse, and the timeline proves they're deflecting from deeper problems. CarMax doesn't sell new imported vehicles. They sell used cars, primarily domestic and off-lease models that should benefit from tariffs making new imports more expensive. Higher new car prices should drive demand toward used alternatives, not destroy CarMax's business model. CarMax's same-store sales were declining in Q4 2024, months before tariff policies were implemented, proving their problems predate trade policy changes. The tariff excuse deflects attention from systematic failures: misaligned inventory strategies, tightening credit markets, and customer affordability crises that began long before any trade policy discussions. Real cause analysis shows loan loss provisions jumping 25% year over year, indicating customer defaults rather than policy uncertainty. Their own lending arm is pulling back on approvals, suggesting internal recognition that their customer base can't afford their inventory. Blaming external factors is convenient when internal decisions created the crisis. CarMax loaded up on expensive inventory while their customers got priced out of the market, a strategic miscalculation disguised as policy victimization. Here's exactly how to leverage dealer desperation into real savings on a vehicle that's been bleeding, carrying costs for months. Identify aged inventory through lot observation and direct questions. How long has this specific vehicle been on your lot? Their hesitation tells you everything about negotiating leverage. Research true market value through multiple sources. KBB, Edmunds, and local comparable sales give you ammunition for realistic offers that account for carrying costs they've already absorbed. Negotiation script. This SUV has been here 120 days at $32,000. Comparable sales show $29,500 market value, and you've paid $800 in floor plan interest. I'll offer $28,500 cash equivalent to stop your bleeding and move your inventory. Present pre-approved financing as leverage. I have 6.5% approved through my credit union. Can you beat that rate, or should we structure this as a cash deal? Bundle timing pressure with fair offers. I'm buying this week if the numbers work. What's your best out-the-door price to move this unit today? The key is demonstrating that you understand their financial pressure while offering realistic solutions that benefit both parties. Individual buyers have limited power, but informed communities can force systemic changes in dealer behavior and pricing strategies, share VIN age tools, lender recommendations, and walkaway scripts in the comments. When dealers realize customers are coordinating information and negotiation tactics, their pricing becomes more competitive across the board. Community success story. I used the VIN lookup tool from the comments, found a 90-day-old truck, and got $2,800 off asking price. Posted my results to help others negotiate similar deals. Flood dealer review sites with specific data points, days on lot, actual transaction prices, financing terms, and add-on costs that reveal their true profit margins. Transparency forces competitive pricing when dealers can't hide behind information asymmetry. The strategy works because dealers depend on information advantages that disappear when customers share knowledge freely. When everyone knows the VIN age, carrying costs, and market values, dealers lose their ability to manipulate uninformed buyers. Collective action through information sharing creates market pressure that individual negotiations can't achieve. We force better deals by eliminating their information monopoly and coordinating our responses to their desperation. CarMax's panic is just the beginning of the automotive reset that's about to reshape how Americans buy cars forever. Next week, I'm revealing the internal documents from Ford, GM, and Stellantis that show exactly how bad they think this crisis will get. Production cuts, dealer closures, and financing changes that will determine which manufacturers survive the coming consolidation. Hit subscribe so you don't miss the confidential strategies they're implementing right now to weather the storm. Share this video with anyone who needs to understand what's really happening behind the scenes. Download 17 Cars to Avoid in 2025 in the description. Your protection against dealers who are getting increasingly desperate to move inventory at any cost. The great automotive reset is just beginning.